paper trades up a little bit. We had a broken wing or iron cockroach trade 10 that we'll look at. It kind of really rallied to the upside today, so we have to do an adjustment or something on that one, but we'll kind of get into that. So first one we're talking about is trade 8. This is our vertical, Tesla vertical that we did on March 9th. We bought a 10-point wide call spread for $2.15 and back on March 9th. And then about 6 days later, we sold a 5-point wide credit spread against it, but we did 20 of them, so twice as many as the longs for $1.10 credit. So that basically, look at the risk graph, gave us about a $50 credit regardless. And I was watching this yesterday about 1 o'clock Eastern, right before, we were hovering at 240, and I was ready to pull the trigger right around, I think, 236, and of course Tesla kind of came right back up to the 248 level later in the day. But this, this is a nice little curve here, and if we do get a pullback in the next 2 days, we are in expiration week here. This could be a nice little trade. So we're up like 270, but we'll see what happens here. Yeah, and here's the positions sheets for some of the new folks. We call it a tally sheet, and we break down the these are all calls. So we're long 10 of the 230 calls and short the 240. And then we're selling twice as many of a 5-point wide spread against it. So you basically got what they call 132 type of butterfly. So next one is trade 9. This is our iron condor. Looking pretty good. We definitely rallied up today to the 200-day moving average, I think around 1130. Put this on at a $2 credit, and the volatility was not too terribly high, so we didn't get I want to get a little bit more credit out of this iron condor, but it's just looking pretty decent. We've rallied up a little bit today, but we got an order in to take this off if we could make 80% of the premium. So an iron condor, you're short a call spread and you're short a put spread. Both in this case 10 points wide on each side, and if you in between the short streaks you make max profit. But if I could buy this back for 40 cents, that way I can go to use that capital in other trades. So it's looking pretty good. Trade 10, so this is our SPX put broken wing butterfly with the iron cockroach, which is causing a little bit of our pain. But so on March 17th, we did a broken wing butterfly to 1950, 1975, 1995 put butter for about 10 cents. So if we look at the risk graph, okay, we'll look at the risk graph in a second, sorry. And this is the iron cockroach that we put on for a credit, and we're ready between our short strikes on our call. So we put that on the 24th, a few days later. And this is our current risk graph. So the broken wing butterfly is this guy. So this trade here is what cost us $100, because I put in for a 10-cent debit times 10. So I'm out $100 if SPX goes to the upside, which it's done quite well, I should say. And after the market kind of ran up on the the 24th, we did a iron cockroach, which is this trade. So again, for some of the new folks out there, an iron cockroach is basically think of an iron condor, but you got no risk to one side. So in this case, if the SPX were to go down to 0, we got no risk to the downside because the put spread's right at the T0 line. The risk is on the upside in the case where at the 2080 level right in between. So we're gonna need to do some kind of a we could do an adjustment, or we could do another risk reversal or something like that. So we'll have to take a peek at that. It's going to be on my short list tonight and tomorrow to kind of keep an eye on that. So, but that's clear that out. But so far, looking pretty good. Other than that, and this is the combination of the put broken wing butterfly. You know, the 1995, 1975, 1950 that we did. So we got $100 wrapped up in here, and that cockroach we put on for a $10 credit, and we only did 5 because this is a 20-point wide spread. So our net position is over here. So Tesla's, so our risk reversals. This is trade 11, and we put this on March 17th. And again, for the new folks, a risk reversal is when we say we're long a risk reversal, that means we're long a put spread and selling a call spread. And in this case, if we're short a risk reversal, then we're in short put spread and long a call spread. So in this case, this is the put spread that we're short, and then we're long the 255 call spread, so you'll see that here in a second. First, we had the risk reversal, and I'll show you the risk graph here in a second. And on the 31st or the 30th, when we had our meeting, we put on, we're looking at this trade, and Tesla had moved up because of, you know, a risk reversal. You want to use that trade if you get a very directional, strong bias on an unlock. So if you're really bullish or really bearish on a stock, that's where I kind of used a risk reversal. So, so right before they announced the news on the Model 3, we were up some money on this particular trade, and we wanted to lock in some of the profits. So what we did is we kind of did the opposite, where we bought a put spread and then sold a call spread, but in this case we only sold half as many calls, and you'll see why here in a second. And we did that for a 50-cent debit. So if we go to and this is showing today's, did I leave it in here? Yeah, so I'm going to go back to the other slide here in a second. I want to show you what it looked like before, because I did an adjustment today. So, so again, for some of the new folks, the initial risk reversal is not the best. So this is the short put spread that we talked about, and then we were long a call spread, and this is not to scale, but so we're long a call spread. So it's a very bullish trade because you want this call spread to be in the money at expiration, and what you're hoping for is the short put spread that you're selling is going to be out of money. And as it goes up, like it did in our case, to lock in some of the profits, we said we want to sell this spread here. Let me do a different color. Let's do a hot pink here. So we sold this call spread here. So this is the 255, 260 spread. So we're selling that to collect a little premium because it ran up, so you get a little bit more juice for selling that. And since Tesla moved to the upside, you know, we were looking to buy this long put spread, and now this long put spread is the, you know, this 210, 205 put spread, and that's going to be cheaper. So this is what we did for a 50-cent debit to give us that particular risk graph. So let me get rid of that. So that's what we had going on before today, because today I did an adjustment. I got to do a pot update after our meeting tonight, but what I wanted to kind of show you is the, you know, here was our max loss in between the two short strikes, but you know, this is our profit area up in this area. But today, what we did, let me go to the previous. So today, well, and I left some of this on. So this is our put butterfly got jumped off here. And what I did is I closed out about 80% of the position that we had up here because we only had 2 days left. I wanted to take in, collect some of the profit that we had in the trade, but I left basically one butterfly on to see if we can get some more juice out of it. So we collected, 385. So that kind of locks in, a minimum, $1,500 profit, but an opportunity to make some more. I probably, could have left another contract on, but I want to take 80% off since Tesla was kind of moving. Again, this is just personal preference. Some people might take the whole thing off, but I like to leave, maybe 1 or 2 contracts on to see if we can let some of that profit run. So this is what we did right around, I think, 3 o'clock. We got 385 credit out of it. So, and again, we got the other Tesla centered on the 240 mark. So if it pulls back around 235 to 240, we got another trade in there to help capture some of that profit. But and if it tanks to 200, we also got an opportunity. But I think it's going to stay around the 250 level here. It looks like might be a little pinning action going on. But again, that's just my personal take on it. So does that make sense for you guys? So we just took a little bit of profits, and we just got one contract out here on the call sides to ink out a little bit more juice out of the trade. Okay. All right, so this is what we had before. Like I said, this is what we have after. Yep, so this is what we got. This is what we got. After. So if it lands in here the next day or two, then we can get a little more money out of the trade. So, but go to the next one here. Yep. So this is again the tally card, and then I'll add in 11C in here for the half the position that we closed on the call. That just happened today. And this is Apple. This is trade 12, and we put this on the 24th, and we put this on for 88-cent debit, and we had Apple's doing some nice consolidating at the 200-day, and it was up again today. So this particular trade, we put it on the 24th, and we kind of knew that earnings was coming up, and so we did a time spread to take a play on the implied volatility. So 30 days out or something, and I know earnings is coming, I might try to play the increased volatility, because as you get closer to typically the implied volatility is going to increase, and time spreads benefit from an increase in implied volatility. So we put this on, and still getting on. It's doing pretty good. We got 450, and kind of sitting almost right in the sweet spot. And I think I put that in there. Yep. So when I showed this last week, and I just want to kind of show you what happens is this top here. This is on the 24th of March. The implied volatility is gone from 24 to 33 on our sold leg, and then the implied volatility on our long leg that was 22.5 is now 24.2. So we're gaining implied volatility on the back leg, which helps increase the value of this 115 call. And as we get closer and closer to expiration, Vega has a less and less effect on the options, because the Vega effect gets smaller and smaller. So, but that's doing pretty good. The next trade, trade 13. This is Amazon, and this is what we call a combo trade. And for some of the new folks, a combo trade is sort of like a risk reversal, but we add some insurance to it. And the insurance to help protect it from, a pullback, and you'll see that in the risk graph here shortly. But we put this on the 28th, and we got collected $1.25 credit on the trade where we're short 30 of the 550, 552 put spreads, and then we're long the 610, 612 and a half call spread. But in addition to that trade, we bought a little bit of insurance, and we bought 10 contracts of the 565, 562 and a half put spreads. And this is kind of depending on how much protection do you want. You may buy more, you may buy less, because what you're paying is going to come out of the credit portion. So in this case, the $1.25 minus the 90 cents, we still collected 35-cent credit for putting this trade on. If you wanted to do less contracts, you would have collected a little bit more money up front, but you may not have had enough. You're not going to have as much protection to the downside. So that's the gist. And Amazon had a very nice, strong day today, and it's sitting pretty up here. So this is our risk graph, and if we go, get my pen out here. So for the new folks, the pink line here, just ignore that little dimple. So that's the risk reversal that we've kind of just talked about, and those 10 put spreads is these guys. So those extra 10 put spreads is causing this little dimple or a little bit of a profit area to the downside. So the nice thing that we have here now is if it moves in our direction, which we mentioned that we collected a 35-cent credit, so that's why you see this T0 line here above zero. That's profit in our pocket. But if we're up money, we can see if we can either lock it in, or if you want to let it keep going, you can. But with only 9 days left, I want to kind of bank some of these profits just in case the market decides to go south on us. We don't want to lose that profit. So what I'm looking at and want to get your guys' input is, I think I put it next one here. So this is a potential adjustment to lock in some profits and also take some risk off the table. So what we got here is we're looking to sell this call spread, which is a 620, 622 and a half call spread. We're looking to sell that, and then we're going to buy this 562 and a half puts and the 560 put spread. So that's this guy. I'm only doing it half because we already had a small put spread here. I'm just going to add to it. So that's what that the other 10 is, because we already had a 2.5 point long call spread here. So we're just adding to it so we get a little bigger dimple. But by doing this, we kind of lock in, almost a $1,500 profit, an opportunity to make more if we close inside the area here, and also an opportunity to make money down here. If I pull this call spread in and go a little bit closer, I reduce the area I can make money, but the amount of credit is like 99 cents versus $1.04. The wider that we can make this, let me clear this up. So this call spread, the further we go out of the money, let's say I want to sell the 630, 635 call spread. If I make that wider, I'm going to collect less credit. It kind of brings it down, and then you can have this larger area. So it's kind of a preference call, but I thought it might be a good way to lock in some profits. What do you guys think? How would you trade this for some of our veterans in here? or I guess let me back up a step and to see how many would you just let the trade go for a little bit, and how many would you just make an adjustment. So okay, lock in some profit. Okay, lock in your profit. Okay. Anyone else? Okay. All right. So probably as the market take profits or earnings coming. Yep. Thanks, Ada. So if we decide to put this on, it's the market's closed right now, and I like looking at positions when the market's closed, so you don't have the market interfering with your thought process. But right now it says $1.04. What I may do is put this order in and see if I can get maybe $1.50 or $1.25, because we could Amazon could spike up in the morning if this rally continues to the upside. We collect a little bit more credit, and that'll raise our line up, and it's going to raise it up even more, so we get more water in under the profit tent here, which is always a good thing. And then if we don't get it, just kind of work it, but I don't want to let too much of it slip, because you're banking in over $1,000 by selling this, but you still got an opportunity to make some money. But it's been a pretty good trade for us. So we'll look at putting this in tomorrow and see if we can get see if we get filled, and I'll send an update out after the market and see how we do. But I'll probably put this in as a let's say $1.50, and kind of see if we can milk a little bit more juice out of it. But if it starts coming down, Amazon starts sinking, I'm going to try to get that filled as quickly as possible.